Yeah, this is Fed week. So why don't you jump into it, break down what did the Fed decide to do and how is that impacting the housing market and mortgage interest rates?
So, this was kind of a Fed. This was like the Fed week that we were waiting for, because they were finally going to pause their rate hikes and all that kind of stuff. And we got a really good CPI report, right? So that came out on Tuesday, and the headline inflation came down significantly. Core inflation or core CPI, which strips out food and energy prices because we have no control over those, and those came down in line with expectations. So inflation's still growing, which we talk about like inflation, right? So it's like it's growing like this month over or year over year. Inflation was the growth of inflation was low, but inflation's still going up 5%. So if you think about that, like we were up 9% last year, right? Inflation was 9%. This year it's 5%. So we're still compounding on that. So
Mm,
if you think about it, like we're talking about as inflation is coming down, what we have to keep in mind, and I was talking to a consumer about this or a client, is like inflation coming down does not mean prices are going to go down. It's the acceleration at which they go up is going to slow down,
great
right?
point.
So we're still all the inflation that we saw last year that made a bag of apples cost
Mm,
$12.99 instead of $8.99. They're not going to go back down by 5%. It's just that they're not going to go from $8.99 to $12.99. They might go from like $12.99 to $14.50.
yeah.
So that's something you have to keep in mind. They're going to continue to compound these prices, and that's why the Fed is really being so diligent about getting it back to 2%, is because the last year inflation has gone up so much and driven up the prices of all these goods, and they're not going back down. That's what
Mm,
people have to understand. And like wages are not going to go back down. They're going to continue to grow on top of what they're growing at. And that's why the Federal Reserve is so steadfast on getting the inflation rate to 2% because they really want to get it down as much as they can. So, the last 10 meetings, they've raised rates from 0% to 5 to 5.25. They always do that range. And so they, at this meeting, which this is where it doesn't make any sense, is that this meeting, they said, okay, we're going to hold rates steady. But the commentary and what really blew up the market was, but we do see two more rate hikes this year. And they raised their forecast to see rates be from 5.5 to 5.75. And that really blew up markets. And one of the things that is really confusing about it all is that why would they pause now?
mm,
Like there's no like it doesn't do like they're looking at the data, right? So they're saying, okay, we want to see, what lagging indicators are doing with the rate hikes that we've been making. And so they want to kind of take stock of what's happening. But at the same time, they're saying they're going to raise it later this year. And a lot of the pundits and the economists and market practitioners, right, like the traders and all the smart people in the room, it makes no sense for them to delay the inevitable. And I always use that. What do they call those comparison things? I can't think of it right now. Oh, analogy. Like it's like starting a diet, and like, hey, I'm going to start my diet Monday, but before that on Saturday, I'm going to go to the cheeseburger fair and I'm going to try all 27 of those mother scratchers they got out there to sample.
yeah.
And so there's kind of two thought trains, right? The market's like, this guy is an idiot, right? They literally think that. They think that the Fed has no idea what they're doing, right? And they're just kind of playing it by ear. And then there's the other part of the market that is like, they're saying all of these things, but they're not actually going to do it. They're actually
Yeah.
going to they don't want the markets to light themselves on fire and give, that consumer confidence back and maybe think that it's going to be worse than it is, or it's not going to be as bad as they think. And it's really hard to tell. But either way, they hammered rates. Rates had a terrible day on Wednesday. We gained all of that back yesterday, and then we're down some more this morning. But we'll probably close out the day just fine. It's kind of we're just still trading in that like high six range, up and down. It might be 7.25 one day, it might be 6.6 the next day, but we're having these like 5/8% vacillations in rates daily, which is kind of crazy.
Yeah, I know. And the craziest thing I think is that as inflation continues to come down, you know, we historically have seen mortgage interest rates follow inflation, and that's kind of what we've been betting on. And so, why do you think that is just that it's fighting that so bad? That because we believed that mortgage interest rates would have been lower now than where they're at in June. And so
Yeah.
I still believe at least that rates still, if you look ahead, trajectory will continue to come down. But what's keeping them from doing that? All right, real quick, and then we'll get right back to the content. If you're a real estate agent, you're looking to build a listing based business, a business where you can generate a multiple six-figure income, a business that doesn't require you to waste thousands of dollars on the new marketing gimmicks, then I'm going to invite you to click the link right underneath this video to learn about our Listing Agent Academy coaching program. This is a 6-month intense coaching system that more than 3,000 agents from every market all over the country have now gone through. And here's the reality. Here's the truth. I will shoot you straight. This program is not for everyone. This is for agents who value being around winners. They value being in a community of other real estate agents that actually show up, that actually put forth the work. And this is for agents that embrace high levels of accountability and visibility. To get the details, all you have to do is click the link beneath this video. You can schedule a coaching consultation and then you can decide for yourself. So with that being said, let's jump back into the content.
So it's just that it's the Federal Reserve's it's the uncertainty in the market, right? And anytime that we're looking at a market that's based on speculation, because none of the technical data that's happening, right? So we follow technicals in the market, like if A happens, B happens, if C happens, D happens. Like we look at all these different things, and none of those technicals are following and are following that normal pattern. So we do know for sure that at some point the market will fall back in line with the technicals. What we're seeing a lot of right now with what's happening with the Fed is nobody knows what's ultimately going to happen. Like, how bad are they going to break it, right? Is it going to be a big recession?
Right.
Is there going to be more banking fallout? Are we going to get hammered with job losses? Like, nobody really knows. And when that happens, you don't have a lot of buyers, right? Like, there's record amounts of cash on the sidelines right now. And when there's no buyers in a market for bonds and mortgage-backed securities, you have to create that liquidity. And in order to create that liquidity, you would have to give a higher rate of return on those securities. So in order to create the liquidity right now to bypass this uncertainty, is they're giving higher rates of return on these investments.
Yeah.
Does that
Well,
make sense?
yeah, absolutely. And I think what I'd like to do too in this conversation this week is I like to look at things both from, on the national level, there's all these numbers and all these stats and all these, um, projections, but that's one thing. The other thing is like what's happening on like what's happening on the streets, practically speaking. And I'm starting to see more homes hit the market right now. Like in our market, as an example, in that price range, because I've got a client right now looking at like the first time home buyer price, like that 250 to 350 in our market. And there's been nothing. Just this week
Yeah.
alone, there was 6 listings that hit the market that was in that price point when we haven't seen anything touch the market. Are you finding that to be the case, that the further we get into the summer, the more opportunities there are for buyers?
Yeah, we're starting to see more of it come up. And if you think about it, in Michigan, this is really this is the last week of school, as crazy as it seems, right? So
That's right.
this is when we should typically start to see things hit the market more. But it's just been a slow roll. And that 250 to 300 market, that market is absolutely bananas.
Yeah,
That's my clients right now that don't have, they're all above ask. Right? Nothing is coming
absolutely.
in at asking price. And everybody looking for, you know, uh, to buy a home above the listing price, we're back to having to guarantee the entire difference between the listing price and the offer price with a cash appraisal guarantee, or they're not even looking at the offer. And we're back to FHA offers not being looked at. We're back to VA offers being recognized again. We're back. It's seeming like this is in every year. There's a different reason for this log jam that we have every year.
Well, yeah,
That log jam breaks and everything kind of picks back up again.
yeah. Well, here's the interesting thing. That's why I bring this up. Like looking at headline data or just the headlines in the mainstream media versus what's happening in the real world. And you hear that time and time again. If you were to look at all the headlines around the housing market, you would think that we are in the biggest housing market crash the world's ever seen. But what we see from the actual practitioners, what we find is houses are selling really quick, multiple offers. And how can those two things be true? This is just, good old mainstream media and getting what sells. And that is bad news, certainly not the good news. So you're still seeing a lack of inventory, your buyers having to compete, getting their asses whooped with multiple offers, just the same as we have over the last couple of summers.
Yeah, for sure. It's kind of funny. It is like a Main Street example, and I'm seeing emails now. We're fighting and doing some reconsideration of value and things like that for an appraisal that came in low. And the appraiser, so this is in an area like a Metro Detroit area. It's called Berkeley. It's a nice area, big hospital. It's kind of a great millennial spot, right? Smaller bungalow houses and things like that. So my client, they put in an offer. The house was listed, I think, like 239. They won the offer at 253. The house ended up appraising a little bit low, and that appraiser had used comps all from January, which showed values of like 240 to 245, which is where we appraised. But they used one comp. So comp one sold in May of this year at 270,000. Two and three were from January at like 240,000. And then comp four and five were both 270 to 275 for less square footage and less bedrooms. So you're talking about over a 10% increase in what homes are selling for in that area between January and May is what we're seeing in this market right now, is just the pressure with more people coming into the market. You're seeing these homes go from 245,000 to 270,000. And they're saying they've got like upgraded kitchens, and it's literally like 7 total cabinet doors of like just your shaker cabinets with laminate countertops. Like it's just crazy what people are getting for houses right now, just in that 6-month period, from super doom and gloom, really not knowing what's going to happen, and where we are now, where there's a little bit more confidence in the market and people have a better understanding of it. So this isn't even that increase and that demand. That's not even coming from a tangible decrease in rates. That's coming from an understanding of what the market is and feeling more secure in buying a house, knowing that the world's not going to explode next week.
Yeah, that's a really good point. How do you see what has been the impact of new construction? What are you seeing out there from the standpoint of, builders are offering these crazy incentives. That's why you've seen new construction do so well this year. It's like they're able to offer these mortgage rates that, I would think that'd be tough for you to compete with. Are you having a lot of clients give up on the resale market and say, you know what, we're just going to build what we want and we can just wait? And, these incentives are crazy. What are you seeing out there?
We are seeing some of that. So, with new construction, there's still a lot of hesitancy because people are still scared of it, right? And there's two ways to go with new construction. There's like the Pulte or Allen Edwin or Lennar. I'm trying to think of some of the KB homes, like some of the bigger national. Those guys, you can walk in your lot, pick out your home, give them a $10,000 deposit, and you go close on your house like anybody else would, 6 months from now. And those homes, we're seeing more and more activity. I mean, those are selling out fast. Problem is the prices. I mean, that the average price of a new construction home right now is like $470,000. They're
Right.
expensive.
Yeah.
You go the route of getting a construction loan where you're doing that type of build, and I'm not seeing that pick up as much, just because, I mean, that's going through it. I'm learning and I'm experienced. That's not for the faint of heart. That's not for everybody.
Yeah. No, that's a good point. It's a good point. It's just, I think that, probably not what you want to hear, but I think it's just it is a viable option to help with this inventory crisis, because that's really the crisis.
100%.
The crisis that we're in isn't home prices. The crisis is nothing for sale and affordability. Those two things
Right.
is the crisis of the housing market right now. And for buyers, it's good to have an option where, yeah, maybe it's more expensive, but they end up at the same place, because I'm hearing some crazy things. I had a good friend buy a new construction and get a 4.5% rate, you know, and making it a lot more
Yeah. So,
affordable.
so yeah, those big companies like that, they can actually buy and hedge a credit line. So you can lock a massive credit line at a lower rate and then in advance. So a lot of those big builders did that where they
Yeah.
hedged millions of dollars in money that they could lend at those lower rates. That's a really good thing. And look, people say that like, doesn't that hurt your business? And it's like, no,
Right.
that's because as soon as you get that family from that existing home into that new construction home, you're putting a home on the market. So for every one of my buyers or every anybody's buyer that goes and gets a 4.5% Pulte new construction, they're opening up a door for my buyer that doesn't have that isn't going to go that direction, and they're putting inventory in the market for us. So no, I'm bring them on. Do all the new construction you can do.
That is a really good way to look at it. Yeah. I mean, that just is another linchpin that comes out and allows some movement in the marketplace. So, looking ahead next week or in the next 2 weeks, as you look ahead for the rest of June, what are some of the drivers? Again, because we all know what is keeping this housing market at bay is mortgage rates. So, everyone's like, what do we have to look forward to that may impact mortgage rates going down over the next couple of weeks?
We got the heavy hitters this week, right? We got the Fed, we got the CPI, which is a consumer price index.
Well, that
We
sucks.
got the
If that's the case,
the
that's bad. Go ahead.
PPI, which and
Yeah.
those came in like the producer price index was like the lowest it's ever. It was like 1.9%. I mean, it was very, very low.
Yeah.
And those were all really good news. And the markets didn't respond to any of that because they didn't know what the Fed was going to do. And then the Fed came and wet the bed for everybody with their comment, with their, that hawkish commentary. And so looking forward, the big one that we have is PCE. So that's personal consumption expenditures. So during this whole, run with the Federal Reserve, they've been saying, we need to see the core CPI at 2%. And that's really
Right.
coming down nicely, stubborn as hell, but coming down. And then they came back this week and they're like, well, now we're looking at core PCE. Now we're looking at a whole different measure. And then at the CPI, they're like, okay, now we're looking at super core. So they've made up another new thing, and super core CPI strips out food, energy, and also shelter, which you and I both know shelter makes up 43% of CPI. And they know that that's a lagging indicator. So now they're pulling that out of the CPI number they're looking at, which is going to make that CPI even more stubborn, because that's really taking into account the prices that we pay for goods, taking in the prices of vacations and things like that. So they just kind of keep moving that marker. But the PCE is coming out, I believe comes out later next week. So we'll have a good look at that one for next Friday. And then from there, we're going to be looking at like weekly unemployment claims. We're going to look at, obviously, there's going to be some housing data that's going to come out about home values and things like that, although that doesn't drive interest rates quite as much. And then in 2 weeks, we'll also get our most recent non-farm payrolls or jobs report, which is always a big market mover. So really, we're just going to be following a lot of the technicals. We'll be watching a lot of what happens with some of these banks and kind of watching to see, we're like on what's going to break first watch right now,
Yeah. No, it's all good. I mean, it's great stuff. And we truly appreciate you keeping us up to speed every week, because yeah, I mean, every week there's things that are moving interest rates in real time. And so we'll continue to do this every Friday. But we appreciate you getting away from the family for 20 minutes. Enjoy your vacation, and we'll see you next week.